Two guys. Same city. Same salary. Same $50,000 sitting in savings. Meet Alex and Ben. Alex takes his 50 grand and puts it down on a rental property. 20% down, just like his uncle told him to. Ben takes his 50 grand and dumps it into a total stock market index fund, then sets up an automatic $300 a month contribution and basically forgets about it. Both of them are convinced they made the smarter move. Both of them are about to find out they're wrong, just in different ways. Alex forgot to count the hours. Ben forgot to count the zeros. And by the time we get to year 20, the real numbers are going to make your stomach drop. Not because one of them loses everything, because what actually happens is so much weirder than either of them expects. Let's start with the setup, because the setup is where the illusion begins. Alex buys a $250,000 house. 30-year mortgage, 7% interest rate. His monthly payment comes out to $1,330. He rents the place out for $1,800 a month. Do that math in your head. $1,800 minus $1,330, and you get $470 a month in pure profit. On paper, Alex is crushing it. He owns a tangible asset. He can point at it. He gets to talk about depreciation write-offs at dinner parties like he's suddenly a tax expert. His friends are impressed. He feels like a real estate mogul in the making. Ben's experience looks nothing like that. He clicks a few buttons, buys an index fund, and that's it. There's no house to walk through, no photo to post, nothing to brag about at a barbecue. His investment is just a number on a screen that occasionally goes up and occasionally goes down. Nobody at the party asks Ben about his portfolio because there's nothing to see. It's invisible. It's boring. And that boredom is about to become the most important variable in this entire story. Now, here's where it gets interesting, because that clean $470 a month Alex thinks he's pocketing, that number is basically fiction. Nobody put surprise water heater in Alex's spreadsheet. Nobody budgeted for the month the tenant left and the unit sat empty. Property taxes, insurance, routine repairs, a leaking roof, a dead HVAC unit, none of that shows up in the simple rent minus mortgage math, but all of it shows up in real life. Once you factor in vacancy, and the national average is close to 1 empty month every single year, plus maintenance, which typically eats 1% to 2% of the property's value annually, Alex's actual net cash flow over his first 3 years lands somewhere between $2,000 and $4,000. Total. Not per year, total. Read that again. 3 years of being a landlord, and Alex has cleared maybe as little as $2,000 after expenses. And here's the part nobody warns you about going in. Being a landlord isn't passive. It's an unpaid, occasionally 2 a.m. part-time job. When the tenant calls because the toilet's overflowing, Alex answers. When the furnace dies in January, Alex is the one calling contractors and burning a vacation day to let them in. Every few years, something enormous breaks. A roof, an HVAC system, and that's not a small line item. That's a 5-figure hit to his bank account, all at once, out of pocket, no negotiating with the water heater about a payment plan. And that's before we even talk about the emotional cost. Picture Alex's phone buzzing at 11 p.m. on a Tuesday. It's the tenant. The basement is flooding. He's not on vacation from this job. There is no vacation from this job. He drives over, finds a shop vac, and spends his evening standing in 3 inches of water instead of watching a movie with his family. That night doesn't show up on any spreadsheet, but it happened. And it's the kind of night that repeats itself in some form every single year he owns that property. Meanwhile, Ben is doing something that looks suspiciously like nothing. He's not managing a single thing. 0 hours, 0 phone calls, 0 contractors. His $300 a month keeps auto-drafting whether he's on vacation, asleep, or hasn't logged into his brokerage app in 6 months. And that's exactly the point. Because by year 10, through nothing more exciting than consistent contributions and compound growth quietly doing its work in the background, Ben's original $50,000 has grown to somewhere between $165,000 and $180,000. Let that sink in for a second. Alex spent a decade fixing water heaters and fielding 2 a.m. phone calls for a return that, on the cash flow side alone, barely cleared a few $1,000s a year. Ben spent that same decade doing absolutely nothing and ended up with well over 3 times his starting money. So, is real estate just a trap? Not so fast. Because there's a piece of Alex's puzzle we haven't talked about yet, and it's the piece that saves him: leverage. Alex didn't buy a $250,000 asset with $250,000 of his own money. He bought it with $50,000 and the bank's money, the other $200,000. That means every bit of appreciation on that property is working on the full $250,000 value, not just his slice of it. Even a modest 3 to 4% annual appreciation, compounding on the full purchase price for 2 decades, adds up to real equity. It's the one lever Ben simply doesn't have access to. Ben can only ever grow what he puts in, dollar for dollar. Alex is quietly growing value on money that technically isn't even his yet. That's why, despite the headaches, despite the stress, despite the years of unpaid landlord duty, Alex's net worth stays shockingly competitive with Ben's the whole way through. Here's a way to picture it. Imagine 2 people racing to fill a bathtub. Ben is filling his tub with his own bucket, 1 trip at a time. That's every dollar he personally contributes. Alex is filling his tub the same way, except somebody handed him a much bigger bucket for free. That's the bank's $200,000, and he only has to keep it from tipping over. The water level rises faster in Alex's tub, for reasons that have nothing to do with how hard either of them is working. It has everything to do with the size of the bucket. But borrowed buckets come with strings attached. If the market turns and rents drop, or if Alex loses a tenant right when a big repair hits, he can't just skip that month's mortgage payment. The bank doesn't care that the water heater died. Leverage cuts both ways. It accelerates gains, but it also means a bad stretch of luck can turn into a real financial emergency in a way that Ben, who owns his shares outright with no debt attached, will simply never experience. Fast forward 20 years. Here's the number that should genuinely surprise you. Both paths land in almost exactly the same place, somewhere between $400,000 and $500,000 in total net worth. 2 decades. 2 completely different lifestyles. Nearly identical outcomes. But identical outcome does not mean identical experience. And this is where the real story is. Alex has built substantial equity by year 20, even with a decade still left on that mortgage. But when you tally up his cash flow profit, the money that moved through his pocket after every expense, every repair, every empty month, over 20 full years, it lands somewhere around $40,000 to $80,000 above his costs. Spread that over 2 decades and ask yourself what he traded for it. Countless evenings and weekends, the mental overhead of being on call for a piece of property, the stress of writing 5-figure checks for emergencies he couldn't schedule, and years where his equity was locked in a house he couldn't easily turn into cash if he needed it. Ben built comparable wealth without lifting a finger past the initial setup. More than $300,000 of his final balance is pure compound growth, money his money made, not money he earned and reinvested. He kept full liquidity the entire time. If he needed cash, he could sell shares in seconds, not months. But don't mistake passive for easy. Ben had to sit through real market crashes, the kind where your portfolio drops 30, 40%, and every instinct in your body screams to sell. The investors who panic sold in 2008 or in early 2020 locked in those losses permanently. Ben's entire strategy only worked because he didn't touch it when it hurt the most. So let's put both sides on the table, because neither of these is the obvious winner. Here's where stocks fall short. There's no leverage. You only ever control the exact dollar amount you put in, nothing more. Cash flow is basically non-existent. Dividends on a broad index run somewhere around 1.5 to 2%, nowhere near enough to live on unless your account is enormous. There's no depreciation write-off, no tax shelter the way real estate offers, and the volatility is brutal. A stock portfolio can drop double digits in a matter of weeks, and that kind of drop is exactly what causes ordinary investors to panic and sell at the bottom, converting a temporary paper loss into a permanent real one. And here's where real estate actually wins. Not in Alex's exact scenario, but when it's run like an actual business instead of a passive side hustle. In markets with genuinely strong rent-to-price ratios, where the rent covers far more than the mortgage, the math tilts hard in the landlord's favor. House hacking, where you live in one unit of a multi-unit property and let tenants cover most or all of your own housing cost, can eliminate your single biggest monthly expense entirely. And for investors scaling up, a 1031 exchange lets you sell one property and roll the full gain into the next one, deferring capital gains taxes indefinitely while you keep trading up. Now, quick gut check. Before you decide which one of these guys you'd rather be, ask yourself an honest question. When your portfolio drops 35% in 3 weeks, do you check it every hour in a panic? Or do you genuinely forget about it? Because that answer matters more than any spreadsheet. Ben's strategy on paper is available to literally anyone with a brokerage account and $300 a month. But it only pays off for the people who can stomach watching a huge chunk of their net worth evaporate on a screen and do absolutely nothing about it. That's not a math problem. That's a personality problem. And it's the real reason two people can run the identical numbers and get wildly different real-world results. So what's the actual lesson here? It's not that real estate is a trap. It's not that index funds are a trap either. The trap is picking a strategy because of a headline, a TikTok, or the guy at the barbecue bragging about his rental, without ever mapping out what it actually costs you in time, stress, debt exposure, and risk over 10 or 20 years. Alex and Ben ended up in almost the same financial place, but only one of them can tell you honestly whether he'd choose that path again, knowing what it cost him along the way. That's the number that never shows up in anyone's spreadsheet, and it might be the only one that actually matters when you're deciding which path fits your life. If this broke down the real math better than anything else you've seen on this topic, hit subscribe, drop a like, and tell me in the comments, are you an Alex or a Ben? I read every single one.